Hi, my name is Ridhi Chitturi.
And my name is Ansh, and today we will be talking to you why New Holdings is an undervalued stock. Before analyzing New Holdings, it is important to understand the industry in which it operates in. The global fintech market is growing extremely fast, expanding from roughly 340 billion in 2024 to over 1 trillion by 2032, nearly tripling in just 8 years. More than 70% of consumers now regularly use fintech services, and for many people, mobile banking is the default. Physical bank branches are increasingly rare as most transactions are handled via smartphones now. The main drivers of growth are digital payments, mobile wallets, AI enabled credit, and lending platforms, along with blockchain for faster and more secure transactions. At the same time, there are risks. Regulations differ by country and change frequently. Competition is fierce with both agile startups and large traditional banks, along with economic slowdowns, which can reduce borrowing and spending. New Holdings operates directly within these dynamics, aiming to capture growth while managing association risks.
New Holdings is a digital-first bank offering checking accounts, credit cards, loan savings, investments, and insurance, all accessible through a single mobile app. The company dominates the digital banking space in Brazil and is rapidly expanding into Mexico and Colombia. Its branch-free model provides a major cost advantage. No real estate, no teller sales, no ATMs. This allows News to charge lower fees, offer better rates, attract more customers, and scale efficiently. Recent developments highlight its growth strategy. Partnerships with Amazon integrate new payments and hiring of crypto and blockchain talent from Coinbase signals serious plans in digital finance. New Holdings is evolved from a Brazilian neobank into a regional fintech platform with global ambitions.
New Holdings has experienced striking growth. Revenue increased from 1.7 billion to 2021 to 11.5 billion in 2024. Over the last 12 months, revenue reached 14.1 billion, up nearly 29% year over year. This growth is significant, occurring on an already substantial base. Earnings are expanding at nearly 45% annually, well above the typical regional bank. Investors are effectively paying only 50 cents for every 1% earnings growth, suggesting the market has not fully priced in NU's trajectory. The combination of scale, high growth, and profitability makes the company's stories compelling.
New Holdings trades at higher multiples than traditional banks, reflecting its growth profile. Trailing PE is around 34. Forward PE is roughly 22 based on 2026 earning estimates. With expected EP growth near 45%, the PEG ratio is only 0.5, all below 1, a classic signal of undervaluation relative to growth. For context, Citigroup trades at a much lower multiples but grows in single digits. New Holdings is effectively a technology-driven financial platform rather than a slow growth bank. EV to revenue is 7.2 times. It's reasonable for a company growing revenue at nearly 40%. This combination of strong growth and attractive valuation points to significant upside potential.
New Holdings is profitable while improving efficiency and scaling. Return on equity is 24 to 28% compared to an industry average of roughly 10%. Net margins approach 40%, meaning $100 in revenue generate $40 in profit. Technology is a key driver. New acquired Hyperplane, an AI startup to improve credit underwriting, fraud detection, and personalization. Better AI allows faster approvals with 40% lower default rates, increasing profitability. Being cloud native keeps costs low, serving a customer cost only 80 cents per month, compared with $15 to $25 for traditional banks. Revenue is diverse across interest income, fees, insurance, and lending, reducing dependency on any single product.
Wall Street is increasingly bullish on New Holdings. Bull case targets for February 2026 are around $23.10, implying roughly 32% upside from current levels near $17.46. Analysts from Goldman Sachs and Morgan Stanley highlight growth potential from expansion in Mexico and Colombia. Analysts also expect New Holdings to maintain a 24 to 28% ROE, far above global peers. Positive earning revisions indicate strong momentum, and even the base case scenario suggests moderate upside with favorable risk-reward profile.
Technical indicators support the bullish thesis. After bottoming near $33.30 in 2022, New Holdings has followed in a consistent uptrend with higher highs and higher lows. Year to date, the stock has surged over 55%. Volume spikes during key breakouts indicate institutional accumulation rather than solely retail trading. The stock trades above its 50-day and 200-day moving averages, confirming long-term support.
A multi-year cup and handle pattern recently broke out. This pattern signals long-term accumulation and institutional buying. When combined with strong fundamentals, it suggests the stock is likely to continue its upward trend. Price targets based on this chart align with analyst estimates in the mid $20.
Approximately 30% of Brazilian adults consider New Holdings as their primary bank. Primary customers maintain larger balances, pay bills, and use multiple products, averaging 3.2 per person. Competitors like Mercado focuses on secondary wallets and cannot replicate this depth. Primary accounts enable cheaper funding, higher cross-selling, and stronger customer retention. This creates a flywheel effect that accelerates growth and profitability.
New Holdings cost to serve a customer is only 80 cents per month compared to $15 and $25 at banks like Ital. Cloud-native infrastructure, AI-driven services, and zero legacy systems allow New to deliver better products at a lower cost. Our bank illustrates this advantage. In 2021, it was $4.50. Today, it's $13.40. Increased usage of insurance, personal loans, and crypto drives revenue per user while costs remain below $1, creating a highly profitable model. New customers in Mexico are expected to level up their accounts similarly, boosting revenue without additional branch costs.
New Holdings faces several key risks. One is dependence on loan income, where lending revenue makes the company sensitive to economic cycles. Another is cybersecurity threats, as protecting customer data and digital assets is critical. We also have geographic concentration, where Brazil is the core market, posing potential regional risks. We also have currency fluctuation, as operating across multiple countries expose the company to current volatility that involving currency. Mitigation strategies include machine learning for credit, where AI models can be a way to improve loan quality and predict defaults, authentication and security that can help strong cybersecurity protocols safeguard platforms, regulatory compliance, where systems ensure adherence to regulations, hedging strategies that can make currency risks and manage them through financial hedges, and market expansion, growing in Mexico and Colombia will help reduce geographic concentration risk. These risks are actively managed using advanced technology, sound financial practices, and strategic geographic diversification.
Holding serves over 127 million users in Latin America. Large underbanked populations in Brazil, Mexico, and Colombia provide opportunities for both user growth and monetization. Acquisitions accelerate expansion, while wealth management and premium credit products increase revenue per user. Multiple banking licenses, including a U.S. national charter, allow further expansion and reduce funding costs. The company is positioned for long-term growth across multiple markets.
New Holding operates as a 100% cloud native institution, eliminating thousands of physical branches and reducing per customer carbon emissions by over 90%. Social impact is substantial. 22 million people have entered the foreign financial system for the first time. Governance is strong, with board led by former central bank president and U.S. National Bank charter in place. ESG considerations are integrated into the business model, forming part of its competitive advantage.
Its proprietary new former model processes 600 billion data points to make credit decisions under 15 seconds with 20% higher accuracy than traditional banks. This provides real-time fraud detection, hyper-personalized offers, doubling product cross-sell rates, and automated workflows handling 85% of customer inquiries, reducing overhead. Risks from AI black boxes are mitigated through explainable AI and regulatory oversight. New leverages AI to create a faster, smarter, and more inclusive banking experience. First, we have the threat of new entrants, which is a 2 out of 5 rating. Even though new fintechs launch often, new is very low to cost serve, and heavy regulatory requirements make it extremely hard for new players to reach scale. Then, we have bargaining power of suppliers, which is a 2 out of 5 rating. New depends on payment networks and cloud providers, but its large deposit base and in-house technology reduce real supplier leverage. Then, we have our threats of substitutes, which is a 2 out of 5 rating. Cash is the main substitute, but in Brazil, digital payments are supported by the Central Bank of Brazil and are rapidly replacing cash. New is positioned to benefit from that shift. Next, we have competitive rivalry, which is a 4 out of 5 rating. This is New's biggest pressure, coming from its large incumbents like Itaú Unibanco and BBVA, as well as fintech rivals such as Mercado Pago. Bargaining and power of buyers is a 3 out of 5 rating. Switching digital banks is easy, but New's strong engagement and primary bank relationships in Brazil reduce customer churn and limit buyer leverage.
In summary, New Holdings is a high growth, profitable fintech with a strong moat, growing revenue from 1.7 billion to 14.1 billion in 4 years while delivering 24 to 28% ROE and operating at just 80 cents cost per user, although AI-driven underwriting. With 127 million users and continued expansion across Mexico, Colombia, and the United States, end-use primary account strategy and cross-selling flywheel positions it for sustained growth and meaningful financial inclusion. At $17.46 per share and a $23.10 bull case target, New offers an attractive risk-reward opportunity in Latin America fintech.